What's up, everyone? Today we are comparing three popular ETFs, JEPI, SPYI, and SPY. If you're looking to make informed investment decisions, stick around because we're about to break down the pros, cons, historical performance, expense ratios, and risks of these funds. Let's get started. All right, make sure you stay until the end where I'll show you how I'm investing in these ETFs and what percentage they are in my portfolio. Maybe it'll give you some insight. Remember, not financial advice, but just some insight. Okay, let's kick things off with a quick overview. JEPI stands for JP Morgan Equity Premium Income ETF. SPYI is the NEOS S&P 500 High Income ETF, and SPY is the SPDR S&P 500 ETF Trust. Those are mouthfuls. All right. These ETFs target different strategies and offer unique benefits. So, which is the right one for you? Let's find out. Also, keep in mind, remember, these are all indexed off of the S&P 500. All right, first, let's look at the pros and cons of each of these ETFs. So JEPI up first. Focusing on generating income, they sell call options on the S&P 500. This means steady income and lower volatility. But there are some drawbacks. The covered call strategy we talked about in previous videos caps potential upside gains and can be complex for beginners. SPYI also employs a covered call strategy on the S&P 500, offering high yield and income potential. It's great for income-focused investors, but comes with sector risk and limited upside due to the covered call strategy. But NEOS does boast some tax-efficient strategies within SPYI, so definitely check it out, do your own research. SPY is one of the most well-known ETFs that track the S&P 500, BOO being the other one. It offers broad market exposure and potential for high growth. However, it doesn't have the income focus of JEPI or SPYI and comes with higher volatility during market downturns. But growth is more exponential. All right, let's move on to historical performance. This gives us insight into how these ETFs have performed over time. JEPI has shown steady performance, especially during market downturns, thanks to its conservative strategy. Its returns are moderate with lower volatility, making it a stable choice for those income-focused investors. Me partially. SPYI has generally provided higher yields due to its covered call strategy. While it may not capture all the market's upside, it does offer more consistent income. And SPY has delivered impressive long-term growth, driven by the overall performance of the S&P 500. It's a great option for investors looking for market exposure and potential for high returns. If you are a growth investor, SPY is the one for you. All right. JEPI's expense ratio is about 0.35%, making it cost-effective for those looking for steady income without the real high costs. SPY's, though, their expense ratio is a bit higher at 0.6%. This reflects the higher management costs due to its covered call strategy on the S&P 500. While it's pricier, the potential for higher yields might justify the cost, and we'll go over that later in the video. SPY has one of the lowest expense ratios at 0.09%, making it super cost-efficient for investors looking for broad market exposure. Okay, now let's get into the dividends. As of the date of this recording, here's the dividend history and the current yield for JEPI, SPYI, and SPY. JEPI has an impressive dividend yield. It yields about 7.21% and paid $4.75 per share in the past year. Dividends are paid monthly, making JEPI an attractive option for income-focused investors. SPY has a more remarkable dividend yield, 12.08%, and paid $3.85 per share in the past year. Similar to JEPI, SPY also pays dividend monthly, offering a solid income stream. Also, keep in mind, SPYI hasn't been around as long as JEPI. Okay, lastly, SPY's dividend yield is lower, around 1.5%, with quarterly payments. So, as we talked about before, it's more focused on growth rather than income. Now let's look at the year-to-date growth for each of these ETFs. How did they do in 2024 so far? As of now, JEPI has a year-to-date growth of 5%. This steady growth reflects its conservative, income-focused strategy. SPYI has shown a year-to-date growth of 4.2%, balancing income generation with moderate growth. Now, SPY has the highest year-to-date growth at about 10%, driven by the broad performance of the S&P 500. It's the go-to for investors seeking market growth. So keep in mind, if you add dividends depending on your portfolio, that may make up the difference in the 10% versus the 4 and 5% of JEPI and SPYI. Okay, lastly, let's dive into the risk associated with each ETF. So, JEPI faces general market risks and income risks from its call option strategy. However, its lower volatility makes it a little less susceptible to extreme price swings. So when the market is up, it won't go too high. When the market is down, it won't go too low. SPYI, much like JEPI, is influenced by the SP 500, but was added risks from the covered call strategy, again like JEPI. Same benefits here, it offers high income, but with capped upside potential. SPY, being a pure play on the S&P 500, carries broad market risks. It's more volatile, but it offers higher potential returns for those willing to ride the market's ups and downs. If you're in it for the long game, for sure these are all good, but SPY, if you really are a long-term growth investor. As promised, here's how I think about these three stocks. In my portfolio, JEPI makes up about 5.24% of my overall portfolio. SPYI is at 6.4%, and SPY is at 3.86%. I like to have a good balance of risk, income, and tax efficiency. That's why you see somewhat close percentages of these ETFs in my portfolio. If you watched my previous video, I'm much heavier than NASDAQ 100 versus the S&P 500, but that's just by preference. Remember, this is not financial advice. I just have a strong background in tech. If you haven't seen my video on JETQ, QQQI, and QQQ, be sure to check it out after this one. So to sum this all up, JEPI is a lower risk option with stable income and reduced volatility, perfect for conservative investors seeking income. SPYI offers higher income potential with a little bit more moderate growth, and that's suitable for those looking for balance between income and growth also. SPY is ideal for growth-focused investors who are comfortable with higher volatility and looking for broad market exposure and are in it for the long term. If you don't need that money right away, I say go for SPY. But remember, I'm just a dude on YouTube. Remember, the right choice depends on your investment goals, risk tolerance, and whether you're looking for steady income or high growth. Thanks for tuning in. If you found this video helpful, don't forget to like and subscribe. Also, hit that notification bell so you never miss an update. I post videos on my portfolio, what stocks I'm looking at, my positions, all the time. So if you want those, notification bell. All right, thanks for watching. See you next time.